Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Following the last 2 weeks of impressive performance in equities, investors have begun to wonder if stocks can rally into year's end. Indeed, a 9% rise in S&P 500 index and a 7% rise in MSCI All Country World Index since October 12th are too good to ignore, especially given that both indices are still down 19% and 22% respectively on a year-to-date basis. But before we assess the next 2 months, let's take a look back at the last 10 months of this year. For sake of simplicity, let's focus on the performance of MSCI All Country World Index, which is a global benchmark for stocks. Between the start of the year and mid-June, global equities were down circa 23%, dominated by concerns about stagflation, i.e., higher inflation and a stagnation in growth combined. As a result, investor sentiment hit a bearish extreme around mid-June. With this technically oversold and bearish backdrop, equities staged a strong summer rally, which in case of US equities was one of the best in about 52 years. Behind this summer rally in equities was a change in the market assessment of the drivers. Most importantly, markets started to believe that the developed world central banks are unlikely to be as hawkish as initially expected. Adding to this, markets believe that a recession, if one materializes, will be short and shallow. Further, Q2 corporate earnings season was stronger than expected, alleviating fears of a sharp plunge in corporate profits. As such, the summer months saw a revival in investor sentiment and hedge funds started to unwind their bearish bets and allowed equities to enjoy a relief rally. This rally did not last for very long as more hawkish central bank rhetoric started to take hold. Between mid-August and mid-October, equities lost 17%, with the month of September being particularly weak. Once again, by mid-October, equity sentiment was bearish, markets were oversold, and positioning was one of caution. Against this setting, markets saw a hope for a Fed pivot, a notion that the US central bank will turn less hawkish. Adding to this, Q3 corporate earnings season was much stronger than expected. With more than half of the S&P 500 companies having reported, 3/4 of them have delivered better than expected earnings. All this has caused equities to squeeze higher over the past 2 weeks. Having studied the equity market performance of the last 10 months, 2 points can be made. First, there are fast-moving drivers and slow-moving drivers of equity returns. In our view, macro factors like inflation, interest rates, and recession probabilities have been the fast-moving drivers, while corporate earnings have been the slow-moving ones. The fast-moving drivers tend to influence equity market returns through changes in valuations, and this can happen very quickly. Even a small favorable change in fast-moving drivers can contribute significantly to positive market returns. For the slow-moving drivers, it is a gradual process and consistency matters more. Second, equity market rallies this year have seen strong enablers. Here, we're talking about bearish sentiment, weak positioning, oversold technicals, and normal valuations. While these enablers are not price catalysts themselves, the degree of enablement determines the extent of bounce higher in equities. Now for the next 2 months, we can state with a good degree of conviction that enablers are still supportive. That shifts the primary focus to the drivers. Given that we've gathered a good amount of evidence on earnings already this reporting season, incremental information from this slow-moving driver is likely to be only a minor driver at this stage. That gives more scope for fast-moving drivers to influence the market direction and magnitude. We think inflation will soften over the next couple of months, but recession probabilities will likely edge higher, giving the central bank policymakers some room to maneuver and eventually pivot. Such a development in the fast-moving macro drivers is supportive of equity market performance, not just in the near term, but also beyond. This would especially be the case if the rise in recession probabilities ends in a mid-cycle slowdown as we expect, rather than in an outright recession. But investors should bear in mind that these macro drivers can cause significant volatility. So, can equities rally into year's end? In short, we think they can, but the downside risks are not at all insignificant. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights podcast.